Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia, and today we will discuss market timing model. Market timing models are simple. You are looking for a way when to enter the market and when to exit some individual market like equity stock index to gain some money and do it in a time when it's profitable for you, and you are trying to avoid the market when there is a high stress or situations when you have a higher probability of losing money. They are quite popular. We have over 250 of them in our database, so they are quite common. What is the strategy I would like to discuss today is trading around tech conferences. So the corporate conferences have been long recognized as important events in financial markets because they show how the companies are prepared for the future, because the companies in those conferences, they are trying to show the new things and they are very strongly watched by other people, and especially the financial analysts and also the investors. So what we can do is that we can take a look and we can analyze growth stocks for some companies such as Apple, Google or Microsoft around their conferences and check whether there are some patterns or drifts and to try to profit from those drifts.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
What we did, so we identified 3 important conferences for each company one. So there is a Worldwide Developers Conference for Apple, the Google I/O Conference for Alphabet or for Google, and Microsoft Build Conference for the Microsoft. Then we downloaded the data for all 3 companies, for Apple, for Google and for Microsoft, and our data sample starts in 2011 and ends in 2025, so we have around 14 years of data, which is plus or minus enough for this kind of analysis. And then we checked what is the price performance around D-3 to D-1 days, so 3 days to 1 day before the conference, over the conference, which we describe as a D0, and then 3 days after the conference, so D1 to D3. In these column charts we can see whether there are some drifts and whether the drifts are before the conference, so during the days D3 until D-1 during the conference, so days D0, or after conference D+1 until D+3. So let's take a look and try to draw some conclusion. Here we have the Apple, here we have the Google, and here we have the Microsoft. So what we can see from those 3 charts. Firstly, strongest drift is around the Google conference, and Google has drift before the conference, during the conference, and also after the conference. The Apple has a drift mainly after the conference and small drift before the conference, and the Microsoft has a strong drift before the conference, a small drift during the conference, and then 1 day drift after the conference. So there are drifts around the conferences, definitely. It seems that there is an effect which is called buy the rumor, sell the news. So it means people like to buy the stocks before and during the conference, in anticipation of what will be said during the conference, and that the conference will have the positive impact on the price of the underlying stocks. So here are the equity charts in case we would like to buy the underlying stocks during the D-2 until D+2 days. So 2 days before the conference, hold over the conference, and then 2 days after the conference, and then sell the position. So here are how the underlying performance will look like. We can see that especially the Google and Microsoft stocks deliver quite a substantial return during the time when those 2 companies have their important conferences. So if we combine all of these 3 stocks together, here is our equity curve, which looks very, very interesting. So we have a yearly performance around 6%, volatility once again around 6%, Sharpe ratio around 1.0, which is really great. And what is important is that those are only 3 events in a year. We have 3 trades in a year. We are holding our position in 3 stocks approximately 20 days in 1 year, and we have over 6% per annum performance, which is really great. What we can ask is that is the underlying drift caused by stocks alone, or is there another effect? So it means that all of the market are drifting at the same time. So if you want, we can build a market neutral strategy, and it's very simple. We just buy the stocks and we short the SPI or SPI ETF. So it means in this case we will remove the effect of the market itself, and we will get just the outperformance of the underlying stock against the market. In this case it's a market neutral strategy, the alpha only. So if you take a look on the charts, you can see that Apple minus SPI spread is not so important, but there is still a significant spread between Google performance and SPI and Microsoft performance and SPI. So if you build the market neutral strategy, and combine all the free stocks, we still have a significant up drift. Yeah, the performance is a little lower, so it's not over 6% but over 3%. Volatility is still around 6%. Sharp ratio is a little lower, around 0.6, but we have the strategy which is really totally independent from the market, so zero correlation to the market. Those are two strategies. I mean, it's up to you if you would like to pick the strategy that has some underlying beta, so I mean it's holding outright position in the stocks, or if you want the market neutral strategy. I mean, in both cases you have an interesting performance. What is the outcome of this is that it really makes sense to pay attention to corporate events. There are some important events during which the stock prices tend to drift significantly, and in the case of the tech stocks, those events are the tech conferences, and each company has like very important tech conference once in a year, and it really makes sense to pay attention to that tech conference, and we can profit out of that. So I hope that you like this simple market timing strategy. In case it's interesting for you or you like it, please give us the like, subscribe to our channel. You can follow us on other social media channels, and if you want to see some other market timing strategies, feel free to review our screener and take a look on the keyword market timing. So thank you very much, and I hope that you will join me in the next video.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.